Have you ever wondered how a seemingly strong economy can suddenly crumble? The Panic of 1907 provides a perfect case study. As we delve into the early 20th century, we find an America that was, on the surface, thriving. Business was booming and the economy was expanding at a rapid pace. But beneath this shiny veneer, there were cracks appearing. The engine driving this growth was not sustainable industry or prudent investment, but rather excessive speculation, fueled by a loose monetary policy. A speculative bubble was forming, with investors pouring money into stocks, real estate, and other assets, hoping to make quick profits. This was a time of great economic optimism, but it was also a time of great risk. The economy was becoming increasingly reliant on this speculation, and as the bubble grew, so did the potential for disaster. And what was the government's role in all of this? Well, it was largely hands-off. At this time, the U.S. did not have a central bank. There was no government institution to stabilize the economy in times of crisis, no safety net to catch the falling pieces when the bubble burst. Instead, the task of saving the economy fell to private individuals and institutions. Top financiers and investors, including the likes of J.P. Morgan and John D. Rockefeller, had to step in with their personal funds and guarantees to bail out the financial markets. This was a precarious situation, to say the least. An economic system where the stability of the entire economy hinged on the decisions of a few individuals was not only risky, but it was also unsustainable. And so, the stage was set for a financial crisis that would shake the nation. The Panic of 1907 was just around the corner, and its impact would be far-reaching, exposing the flaws in the National Banking Act of 1864 and leading to significant changes in the way the U.S. government oversees and manages its economy. As we move forward, we'll explore how this crisis unfolded, the aftermath, and the critical role it played in the creation of the Federal Reserve. The lessons from this chapter in history still resonate today, and understanding them can give us valuable insights into our own economic realities. Now, let's delve into the heart of the crisis, the Panic of 1907. As the 20th century dawned, the United States was a nation brimming with optimism and growth. Yet beneath the surface, an economic storm was brewing. The Panic of 1907 was a financial crisis that shook the nation, driven by a buildup of excessive speculative investment fueled by a loose monetary policy. The crisis was triggered by a failed attempt to corner the copper market by two unscrupulous speculators, Augustus Heinze and Charles Morse. When their scheme went belly up, it sent shockwaves through the banking system, leading to a run on the banks as depositors scrambled to withdraw their savings. Banks and trust companies crumbled under the weight of the panic, and the stock market plunged. In the absence of a government central bank, the responsibility of saving the financial markets fell upon the shoulders of private individuals. Among them were two of America's wealthiest and most influential financiers, John Pierpont Morgan and John D. Rockefeller. J.P. Morgan, often referred to as the Napoleon of Wall Street, was a man of immense wealth and influence. He used his personal fortune, as well as his influence over other financiers, to inject liquidity into the market, effectively bailing out the struggling banks. His actions, while controversial, were instrumental in stabilizing the financial system. John D. Rockefeller, another titan of the era, also played a crucial role in quelling the panic. He deposited a significant amount of his personal wealth into the banks, providing them with the necessary capital to weather the storm. His actions not only helped to stabilize the banking system, but they also served to restore public confidence in the nation's financial institutions. The Panic of 1907 exposed the limitations of the National Banking Act of 1864, revealing that it didn't cover all banks. The crisis underscored the need for a more robust framework to safeguard the nation's financial stability. In the aftermath of this financial turmoil, it became clear that changes were necessary. The Panic of 1907 left a lasting impact, but what exactly happened in its aftermath? The aftermath of the Panic of 1907 was a period of reflection, introspection, and ultimately, action. Financial markets were in disarray, and the economy was reeling from the shock of the crisis. The panic had exposed the fragility of the banking system and the inadequacy of existing financial regulations. Individuals, businesses, and even the government were left to pick up the pieces and brace for the long road to recovery. It was a time of hardship, with people losing their savings, businesses going under, and unemployment on the rise. The panic had shaken the country to its core, revealing the cracks in its economic foundation. But amidst the turmoil, there was a growing consensus that the status quo couldn't continue. It became clear that the banking system needed a safety net, a guardian of sorts, to prevent such a crisis from happening again. The realization that more government oversight was needed in financial markets was beginning to take root. The panic had shown that the National Banking Act of 1864 was insufficient. It didn't cover all banks, leaving many vulnerable and without a safety net during financial crises. This realization was a wake-up call, a signal that change was necessary. And change did come. The Panic of 1907 was a catalyst, a spark that ignited a movement for reform. It gave impetus to plans to impose more government oversight and public responsibility to bail out financial markets. This led to the creation of a government central bank, a revolutionary concept at the time. This new institution was designed to serve as a lender of last resort, a fiscal agent for the U.S. government, and a clearinghouse. It was a significant step towards a more stable and regulated financial system. The Panic of 1907 was a period of turmoil and hardship, but it was also a period of change and growth. It was a turning point that led to the creation of one of the most influential financial institutions in the world, the Federal Reserve. This aftermath led to a pivotal moment in U.S. financial history, the creation of the Federal Reserve. So, why exactly was the Federal Reserve created, you may ask? Well, it was born out of a need for stability in the financial system following the Panic of 1907. The Federal Reserve was created to serve three main purposes. First, it was intended to act as a lender of last resort. In other words, during times of financial stress, the Federal Reserve could step in to provide funds to banks to prevent them from failing. This was a role that private individuals like J.P. Morgan had taken on during the Panic of 1907. But it was clear that such a system was not sustainable in the long run. The Federal Reserve was created to provide a more reliable backstop for the banking system. The second purpose was for the Federal Reserve to serve as a fiscal agent for the U.S. government. In this role, the Federal Reserve would manage the government's money, including issuing and redeeming government securities. This would help ensure that the government had the funds it needed to operate, and could also help manage the money supply to prevent inflation or deflation. The third purpose was for the Federal Reserve to act as a clearinghouse. In the banking world, a clearinghouse is an institution that facilitates the exchange of payments, securities, or derivatives transactions. By acting as a clearinghouse, the Federal Reserve could help ensure that transactions between banks were carried out smoothly and efficiently, reducing the risk of a bank failing because it couldn't meet its obligations. These three roles were all designed to help create a more stable and reliable financial system. The creation of the Federal Reserve was a clear response to the challenges posed by the Panic of 1907. The crisis had exposed significant weaknesses in the U.S. banking system and had shown that a more organized and systematic approach was needed to prevent future panics. The Federal Reserve wasn't just a new institution, it was a new way of thinking about banking and finance. It represented a shift away from a system where individual banks and financiers were responsible for their own survival, towards a system where there was a collective responsibility for the health and stability of the financial system. The creation of the Federal Reserve was a direct response to the Panic of 1907, a solution to the problems exposed by the crisis. Fast forward to the 21st century, and we see history repeating itself. As we delve into the 2008 financial recession, striking similarities to the Panic of 1907 begin to surface. Both crises were rooted in an overabundance of speculative investments and a lack of proper oversight. In the early 20th century, this speculation was in trusts and the stock market, while in 2008, it was in the housing market and complex financial instruments like mortgage-backed securities. In both instances, when the bubble burst, it led to a widespread financial crisis that threatened to bring down the entire economy. There were also significant differences between the two crises. In 1907, there was no central bank to act as a buffer against the economic shock. Wealthy private financiers like J.P. Morgan and John D. Rockefeller had to step in to prevent total economic collapse. In contrast, in 2008, the Federal Reserve, created in response to the Panic of 1907, played a critical role in managing the crisis. It provided liquidity to banks, lowered interest rates, and even bailed out some financial institutions. However, its actions also sparked a heated debate about the role of government in the economy, much like the aftermath of the Panic of 1907. So, what lessons can we take from these two economic upheavals? First, unchecked speculative investment can lead to disastrous consequences. Second, proper oversight and regulation of financial institutions is vital to prevent such crises. And finally, when a crisis does occur, a central bank can play a crucial role in mitigating its effects. Yet, despite these lessons, we seem to be caught in a cycle of boom and bust. Are we doomed to repeat the mistakes of the past? Or can we learn from history and forge a more stable economic future? As we can see, the Panic of 1907 still holds valuable lessons for us today. So let's keep these lessons in mind as we navigate the complex world of finance and strive for a system that is both prosperous and stable.